Hello and welcome to Policy Watch. We have a new foreign trade policy. It sets a target of $900 billion of exports by 2020. In addition, it hopes to ease procedures, encourage new sectors like defense and pharmaceuticals, as well as new services. The question, however, that we are asking today is, where does India stand today in the global competitive market, and to what extent can this policy help take trade forward? Well, joining me to discuss that are two gentlemen, Ajay Dua, former Secretary of the Ministry of Commerce and Industry, Government of India, and Santosh Mehrotra, Professor of Economics at JNU. Gentlemen, thank you very much for joining us. So, Mr. Dua, let me dive in, right? So, it's an ambitious target. It also hopes that India's share of global trade will go from 2 to 3.5% in the same time period, which is 5 years. It also comes at a time when things are not really going well for the Indian economy, and particularly from a production, manufacturing standpoint. So, how is this all adding up?
Ambitious,
okay,
but I think well worth a shot. Because if we are able to succeed in the accompanying Made in India, Skill India, Digital India, those kind of programs with which the trade policies sought to be aligned, I think it can help in increasing the competitiveness of Indian products and services.
Right.
Something which is a cause for concern, considering we are being constantly reminded that you can't become partners of regional economic forums, etc., particularly the Trans-Pacific, Trans-Atlantic, because you have too much of protection in India for your industry. And I remember hearing the Commerce Secretary yesterday who said our average tariff rate still continues to be about 15%, which is far too ahead. And if we have to be competitive, we have to do away with subsidies and get our adjunct programs, which I just mentioned, in position to be able to take forward our share of the global trade.
Right. Okay. Dr. Mehrotra, let me ask you. So, this confluence of Make in India, Skill India, so which feeds which? I mean, the target is an ambitious one for which obviously you need production of services or of products, creation of products and services in this economy, to which a Skill India should feed into or a Make in India should feed into, or is it the other way around?
No, I mean, Skill India feeds into Make in India, which feeds into a foreign trade expansion.
Yeah, at least logically.
And logically, the expansion of exports. But that's precisely where the crunch comes, that we are facing, our manufacturing industries are facing skill shortages. And above all, our manufacturing industries are not terribly competitive globally. And that's the foundational problem. So we should look at foreign trade policy as something that's important, but only at the margin.
Okay.
We've got to deal with the structural problems. There are at least 5 sources of problems which hinder or undermine our competitiveness, our cost competitiveness. One is lack of scale economies. I mean, in a sector, for instance, like textiles or garments, where you would expect us to be competitive. Unfortunately, the Chinese, Vietnamese, the Bangladesh is actually more competitive.
Right.
So, we don't have the scale economies. Our enterprises are no more, hiring sort of have workers of the size of 40, 50 workers, while, Chinese are 4,000 and above. Secondly, our interest rates still are relatively high. Those have, kept our costs high. Thirdly, our real wages have been rising. Fourthly, we've suffered from an inverted duty structure. Now, thankfully, let me just say a few words about what an inverted duty structure is. We've seen some deindustrialization taking place in our country for the last few years, because finished products were incurring a tariff which is lower than intermediates or raw materials which go into the production of finished products in India. So it was cheaper for potential manufacturers in our country to actually simply import the goods rather than. So then the inverted duty structure was impacting at least 22 product groups, including capital goods. And thankfully, that has begun to be changed in the budget. So that's very good news. And finally, there's another, so that's a very important, input into foreign trade policy, which is not reflected in this foreign trade policy. And the final thing is the cost of electricity. I mean, we've got cost of electricity for our manufacturers is high because they have to, our plants are not able to generate the electricity. Captive power plants is a problem.
Right. So, Mr. Dua, let me come back to you. If we were to look at the global economy today, cast an eye over the landscape, so to speak, what do things look like? Where is India stacking up?
Well, India might be doing somewhat better than a few other countries, but the fact of the matter is,
and not necessarily because we designed it so. It just so happened.
So happened. If we have to get our exports doubling up in 5 years' time, because I don't think this year is going to be very much larger than last year, if we are able to, in real terms, just have it at that level also, it requires doubling up.
And it's a good point that you raised, because we've actually seen exports declining in double digits for the last 3 months consecutively.
Absolutely. Right? So I think a lot would depend, of course, upon our competitiveness and what was just mentioned into what feeds into it. And into that feed, I will just add a couple of issues. One is not merely electricity, the whole infrastructure of transportation. Absolutely. That's extremely, I think we are way behind. It adds to our costs, whether it's road transportation, rail transportation, or any other mode. And secondly, the whole, these kind of procedures, transaction cost is extremely high in India.
Right.
That is why you see that World Bank study.
Right.
One of the things where we constantly pulled back, one is of course construction permits by municipal and the state bodies, and the other is the cost of doing business here, and particularly in exports, trade. But come back to the larger issue. I think the recovery, global recovery in the next 5 years is a prerequisite for us to be able to double up our exports.
So let me put the question.
And that doesn't seem to be happening.
So let me put the question a little differently. Has anything changed this time around? Right, we've come back into a global economy with things in our favor. Again, maybe we didn't hope to do it like this or didn't expect it, but things are in our favor. Many of the other BRIC economies, for instance, are not doing well. So we have certain advantages as we go into this cycle.
Advantages as well as disadvantages. If the size of the global trade is not going to be growing, how would we go from 450 million or 466 million of last year to 900 billion next year? Sorry, the figure should be billions.
2020.
If our absolute figures has to go up, it requires that this global trade also expands faster. And on top of it, we are saying from 2% to go up to 3.5%. That means we have to grow much faster than the global rate of growth. My concern is that first, the global rate is not going to be going up. The growth is not going to be happening in trade so much because the recovery in the advanced countries who are our major trading partners is not likely to be as fast.
So our bet has to be really on increasing share, not necessarily, and not hoping
not increasing the volumes too much.
Would you agree, Dr. Mehrotra?
Yes. In fact, I would say that we have to take the international market as given, and therefore we have to focus on our own competitiveness even more. I mean, in addition to the factors that Mr. Dua rightly added to my list, there is yet another item that we have to worry about, is the real effective exchange rate. Because you see, we are an economy, an emerging market economy, which is inviting foreign inflows, particularly foreign institutional investors are desiring to sort of come in a bigger and bigger way. And we are, because our fundamentals are reasonably strong, FIIs will come in. Now, the implication of that is that our rupee is going to continue to, has remained strong, and it may continue to remain strong. Which
and the presiding view is that we want a strong rupee.
But that affects our exports.
Exactly. But I'm saying the view seems to be that we want a strong rupee.
If you do, then let's worry about the overall balanced BOP, not necessarily exports. Because for exports, as we all know, that's actually an adverse factor.
Right. So you've added exchange rate as another sort of another factor in the mix. But if you were to talk about competitiveness overall, and that's an important issue going forward, because that's the only thing, or amongst the one or two things that you can work on, can things really change in coming years? Is my question, Mr.
Yes, I think those can, given our entrepreneurship. We've had this very entrepreneurship, say in 2005 to 2007, 8 worked and produced results. The fact of the matter is, at that point of time, what was different and what's different now, if we look at it, I think it's fairly clear. One is the confidence in the industry, the investors' confidence is coming back. We had foreign investor confidence, Indian investor confidence. That with the change of government has come back. So that's a very positive. Second, I think the right things are at least have been diagnosed and some action has been initiated.
Right.
It may be slow, it may be slower than what people expected or what was promised to them. But the diagnosis having taken place, action has been initiated, and I'm optimistic that unless we we mess it up ourselves, so to say, that probably we could be recovering and may not be 900 billion, but certainly we would have taken.
Right. And let me come to the breakup in a moment. But before that, as in tax, when the union budget was declared, I mean, the general response was that, while the government and the finance minister did talk about a non-adversarial tax regime, the feeling was that it was not really non-adversarial and it was continued to be as adversarial, particularly administratively. Similar concerns are expressed in trade.
Yes.
Not obviously by the tax authorities, but when it comes to procedures and so on. So one step, for instance, talks about merging 5 schemes into one program and so on and so forth. Are these, you think these could make some difference?
I think...
Oh, you've already accounted for that,
Those would. We must remember one thing. We may be making things simpler. 5 exports, merchandise export schemes into one, simplifying the serve from India into made in Indian service, etc. Those things are all desirable, and it will make it easier for people to claim their benefits, and then the benefits also being made tradable. These have been demands on the table for quite some time, but we must remember that the extent of subsidies is going to be coming down, and that, to my mind, in the short run could adversely affect competitiveness. But in the long run, it's going to be better, make people stronger, and find ways and means to get their products made more competitive.
Right. Dr. Mehrotra, last word. What's the unfinished agenda here? I mean, this has been outlined. It's a reasonably progressive document. We seem to agree. What's
the
remaining?
Unfinished agenda is all on the domestic side, meaning in order to make in India going, there's a whole series of things that we've already talked about in order to improve our competitiveness and reduce our costs, which is going to enable us to compete internationally. Because let's face it, that over the period that we saw our export to GDP ratio rise from sort of 11% of GDP in the early 90s to 25% in 2007-8, that is a period of growing trade and growing international economy. We're in a different world altogether. Therefore, the pressure on the government delivering on the various things that we've talked about is absolutely enormous.
Right, and critical. Last word, Mr. The unfinished.
I think we are on track. Let's hope for the best, and one of these is let's hope that the global economy recovers faster than it has in the past.
So we are betting on the rising tide as well.
Absolutely.
A rising
Otherwise,
tide.
You don't get your $900 billion. You don't reach that target.
Right, and unfortunate as it might be, but that is likely to be the case as things appear. But let's hope that things look up for the world trade as well, and India gets its fair benefit. Thank you very much for joining us. We need to take a break, but coming up on the other side, we asked that vexing question: why are banks not dropping interest rates? CM Vasudev, former finance secretary, and A.K. Bhattacharya, editor of Business Standard, are going to join me. Stay with us. Welcome back to Policy Watch. The Reserve Bank of India has cut interest rates twice this year. More cuts are expected, but banks, public sector or otherwise, are not really taking the cue. The finance minister has hinted that banks should drop rates, and industry is clamoring for it. Not much help, at least so far. Why is it that banks are not dropping rates, and does this reflect a more fundamental challenge or weakness in the economy? Joining me to discuss this issue are CM Vasudev, former Finance Secretary, Government of India, and A.K. Bhattacharya, editor of Business Standard. Gentlemen, thank you very much for joining us. Mr. Vasudev, is this reflecting something more fundamental, which is something beyond perhaps the comprehension of the layman, who's obviously expecting that rates will drop, things will improve, and so on?
Well, it's not entirely correct to say that RBI has cut interest rates as such. It has only reduced the repo rates and the reverse repo rates and all that. And that is only one tool which RBI has used, but it has more sort of potent tools in its arsenal, like CRR or SLR and all, which have a direct bearing and more direct bearing
Which have
on
not
your
been
liquidity
touched.
in
Yeah.
the market.
At least CRR is not being
and
touched,
interest rates are really a function of how much money is floating around in the economy. So liquidity, if RBI were to loosen the liquidity more by cutting CRR or reducing SLR and all, probably it will have a more direct impact. But I think even this, RBI probably is doing it in a very calibrated manner. It just doesn't want the interest rates to suddenly come down very sharply. So you are already seeing some signs of the banks responding to that. High value deposit rates have been reduced by some banks. Some banks have reduced that. Some banks are even trying to reduce the lending rates. So it's a very slow process of transmission of this monetary policy of the RBI through the banking system. Because, banks are locked into lot of assets and liabilities based on the old regime, and to suddenly change is not easy. So it starts with high value deposits on the liability side of the bank. It will come down to the lower value, then it will get transmitted to the asset side. So it is a slow process by definition, this repo rate reduction. But I think if RBI was really more serious, if they had cut CRR and SLR, probably the impact on the interest rates would have been much more direct. Okay. But consciously, perhaps RBI has chosen to choose this more calibrated tool in its arsenal.
Okay, so we'll debate the arsenal a little more. AKB, what's your sense? And more importantly, what is the impact that this is having? The clamor for lower interest rates, I mean, whoever cuts it and whoever transmits it has been there and increasing in intensity for many years now.
Well, I look at, money is like any other product and it has got a price. And if the price is not attractive enough, there won't be much demand. And this is exactly what is happening to interest rates. Now, interest rates at this level is not good enough to induce higher credit, which is why you have seen that credit as on March 20, as our newspaper reported, is 21-year low growth, So I think there is not enough appetite for new loans at this interest rate.
Right.
And given the economic growth cycle the country's economy in right now, you don't see that the domestic borrowers are willing to go in for bank money. Instead, they're going in for corporate bonds, which has seen a rise of 31% in 2014-15. So what are the companies doing?
And overseas borrowing.
Overseas borrowing, of course.
Yeah.
So what are the companies doing? Essentially, they're saying, listen, at this 10.5% base rate, 10.5% base rate, I'm not going to borrow your money. I'll rather go into the corporate bond market or borrow it from abroad where I'm getting cheaper money. So to me, it's a simple case of demand-supply economics where the price is not correct, you will not be able to get more demand.
Right. So what we are trying to understand, Mr. Vasudev, is what is the impact of this on the economy? I mean, I guess it's logical what the impact is, but it surely must be creating medium to long-term damage.
Well, surely that is why there was so much of clamor for a reduction in interest rates, because it was supposed to be a big growth impetus. That is the trade-off between inflation management and growth, interest rates. If interest rates are high, probably it's a better way to control inflation. If interest rates come down, then it provides some impulse for growth. So that is what people are expecting, that you are reducing interest rates. Where is the growth impulse? I think people need to be a little more patient in that. Of course, as Mr. Bhattacharya has very rightly said, growth, that money has a cost. Interest rate is a raw material which goes into production. If raw material cost comes down, the cost of production will come down, the goods will become more competitive. If credit price comes down, there will be more demand, especially in the consumer segment. If interest rates are low, there will be more incentive to make investments. So that is how it sort of impacts on the growth cycle. And that is what people are expecting. It will happen. I'm not saying it won't happen, but it is a slow process. It is just not like pressing a button and you press this button and suddenly growth starts picking
so let's
up.
understand
we are in that process.
Right.
We are in that process.
So let's understand or ask the question about the intermediary then. Is the banking sector, I mean, we know that there are problems with the banking sector. Are the problems in the banking sector also manifesting themselves in their inability to lower rates?
Well, the problems in the banking sector, a lot of people talk about NPAs and all, but I believe the intermediary sector, the banks are, and the real sector, which is the user of those savings which the banks are intermediating. So if the real sector is not doing well, how can the intermediary sector do well? So a lot of the NPAs, if you take out those sort of willful defaulter type cases, a lot of them depend on how well the real sector is performing. If the real sector is not performing well, the NPAs are bound to go up. But if real sector starts performing well as it is expected, then perhaps the NPAs will come down. But surely making provision for NPAs is a cost for the banks because it adds to the spread. So that is happening. That is one of the reasons for the public sector banks, more so where the NPAs are very high. But I would still tend to believe that a lot of these NPAs are a function of the performance of the real sector, because most of them are in infrastructure sector like power and roads and this and that. So if that sector picks up, a lot of the NPA problems of the banks should be taken care of. Of course, the willful defaulters will have to be dealt with separately.
And okay, so let me sort of expand the landscape a little bit. Suppose we were to cast the eye globally and look around the world and say, you know, interest rates may rise elsewhere, may come down, cost of capital may be cheaper. How does that impact the situation in India? I mean, and how should we be reading that?
But you know, what is happening is, of course, our real interest rates are still very high by global standards. Maybe, I don't know, what it would be 6% plus real interest rates?
Well, yeah, I mean, if you take the consumer pricing, it's 6 plus.
Yeah, so real interest rates are still very high as compared to global standards. So they have to come down. It is just, I think, not possible. It defies the logic of economics that you have continued to have real interest rates of 6% plus for the rest of the economy. But rest of the economy has its own problems. Europe has a different set of problems. America has a different set of problems. Fortunately, the US economy is doing well. There is loosening of interest rates, picking up of some QRs in Japan and all. So things are happening. So I think we are now living in a globally integrated economy. So we can't remain unaffected from what is happening in these other countries. Right. But I suppose we are on the right path. That's what I would say.
Okay, AKB, what lies ahead? I mean, you know, the signals, I mean, we've looked at all the signals or the noise and the signals. So what do we make of this, and what should we be expecting or hoping for in the context of banks?
Well, you know, RBI has a really difficult job ahead because you have the inflation signals have turned a little adverse. Yeah, in a sense, there is a rising inflation. You have an unseasonal rains, which is causing some doubts on the country's ability to come out with another bumper crop. Food prices, which is now almost 45 to 47% of your CPI index, which is going to be your inflation targeting instrument. So RBI is really facing this challenge of what it should do with the inflation monster. But on the other hand, the real economy, the growth signals, whatever may be your revised GDP numbers showing, the actual ground level, the reality is your IIP is still hovering around 1.5% growth. Your corporate earnings are very tepid. Now, so if you have to look at the pros and cons of the inflation and the growth revival, I would say the RBI perhaps should tilt slightly in favor of the growth impetus that this economy needs, and perhaps nudge a little more on the interest rate side by reducing it a bit.
Okay, so if your growth is your target, which it ought to be, then I think things fall in place quite neatly.
Would you agree? Yeah, but I would even go to the extent of saying that RBI should use some of its more potent tools like CRR reduction and all, which will have a much more, I think, direct and earlier impact on the interest rates rather than this repo rates.
Is it something that should be handled? I mean, maybe crisis is a stretched word, but with some urgency at this point?
Well, urgency in the sense that probably you are missing opportunities for growth which are there today, and there is a lot of opportunity with China slowing down and a lot of manufacturing activity moving out from China to other countries. This is a time to capture those opportunities. So, to that extent, we are missing out on those opportunities.
Right. You talked about the crisis. The crisis in the banking sector. The kind of the leverage the banking sector is, and the 8.5 lakh crore of money has to be pumped in by way of capital to the public sector, banking sector in the next 5 years. Now, I don't know whether either the government is giving them money or the public sector has the financial muscle to raise that money from the market through tier 2 capital. So that's a big question mark. That's the crisis.
Right, absolutely. And we've run out of time, not on a very optimistic note, but hopefully rates will drop as the growth impetus becomes clear. Thank you very much, gentlemen, for joining us. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.